everyone. I'm Kevin, and welcome to Investors of Today, a show where we discuss the do's and don'ts of investing. Last week, we had two students from the University of Western Ontario submit a video for our Student Investor segment. Check this out.
Hi Kevin, just wanted to say thanks for allowing us to have this opportunity to be on your show. My name's Alex.
And I'm Emily.
And we're business students at Western University.
We're studying accounting, and even though we have some finance experience, we really wanted your investor information to help us figure out some stocks to invest in.
We consider ourselves risk adverse, mostly because we're students with low income and we're looking for some long-term investments.
We really want to invest in a banking stock and a retail shop because we love
Shopping!
So if you could let us know of a good diversified portfolio, that would be awesome.
Thank you!
So from what we could gather from these students was they really wanted to be risk-adverse long-term investors. They said that they wanted a retail company and a bank company in their portfolio. So tonight we're going to look at some shares our analysis have recommended to us. Toronto Dominion Bank, Loblaw Companies, Hudson's Bay Company, and Eldorado Gold Corporation. TD Bank had $1.2 trillion in assets to start 2016. TD also ranks among the world's leading online financial services firms with approximately 10.4 million active online and mobile customers. Loblaws is a distinctly Canadian brand that has in recent years made some large acquisitions of other major brands like Shoppers Drug Mart and created profitable and long-term synergies with both operationally and commercially. HBC is a leading North American retailer offering a wide selection of branded merchandise in Canada and in the United States. HBC operates three of the world's most iconic retail banners: Saks and Fifth Avenue, Lord & Taylor in the United States, and Hudson's Bay in Canada. Eldorado Gold Corporation is a global gold mining company with a local operating philosophy. Our analysts began by looking at some key ratios such as earnings per share, current ratio, and debt to equity. Toronto Dominion Bank has a consistent earnings per share growth throughout the last 3 years, with strong growth in new markets and the company's retail ventures. The operating margin in recent years has decreased since the company has made large investments in new market ventures like their private label credit cards offering rotating credit lines specially to TD customers. Due to its large size in the banking sector and its stability, TD does not compute its current ratio to the highly liquid nature of its assets, mostly cash and marketable securities. Due to this unique position of consistency and stability, TD has a strong financial leverage foundation mostly based on equity, meaning that it's not obligated to pay large interest payments or principal payments to its debtors. Our analysts have determined that the TD stock should account for 63% of your portfolio. Loblaw's current ratio reveals a strong liquidity foundation, meaning that its assets are highly valued on the market and it will be easier to find buyers. The company's debt to equity ratio means that it finances its operations through more equity than debt. This is a healthy debt-equity ratio since the business is growing financially and is stable. Loblaw's earnings per share fluctuates, which may be concerning for investors. Loblaw seeks a positive future growth, and it is unlikely that the stock will underperform under current operations. Our analysts have determined that Loblaw stock should account for 32% of your portfolio. The Hudson's Bay Company's current ratio is greater than 1. Meaning that they have the ability to pay off their current debts. However, the quick ratio is less than 1, which means the current liabilities would not be covered by the most liquid assets of the company. Earnings per share is only positive in 2015, which may show concerns about profitability to risk-adverse investors. Hudson's Bay Company's debt-to-equity ratio is concerning as they have more debt than they do equity in 2014 and 2015. Meaning the shareholders' equity will not be able to fulfill their debt obligations. Our analysts have determined that HBC should account for 3% of your portfolio. Eldorado Gold Corporation. We see that over the past 3 years, earnings per share is very volatile due to the fluctuations in gold and precious metal prices during these years, which has affected the overall profitability of the company. We see that Eldorado has a very high current ratio, which is seen to be quite stable over the past 3 years. Eldorado's ability to liquidate its assets are quite high, and they have the ability to do so if the need arises. The debt-to-equity ratio is very low and stays consistent throughout the past 3 years, due to the fact that most of Eldorado's financing is done through equity financing, which also explains why earnings per share is so low in 2014, due to the fact that there are so many shares outstanding. Eldorado stock has been slowly and steadily decreasing for the past 3 years. This is not surprising considering the price of gold has also been decreasing for 3 years. However, in 2016, the prices of gold started to increase, which shows that Eldorado has potential for growth in the current fiscal year. Since Eldorado is our riskiest asset, our analysts have determined that the Eldorado stock should account for 0.7% of your portfolio. Let's give our analysts a call so they can explain how they came up with these findings.
Hi Kevin, it's analysts Haley, David, and Natasha here. In order to provide you with the best data for your student investors, we analyze the stocks individually as well as in portfolios with and without the risk-free asset. For each company individually, we analyze the daily returns and calculated key statistics including the maximum and minimum returns, as well as the variance and standard deviation. We then graph the frequency distribution of the daily returns.
We also compared each stock with the risk-free asset by calculating the covariance and correlation between the two and graphing the daily returns on a scatter plot.
Finally, we created portfolios with all 4 stocks, both with and without the risk-free asset. This gave us the optimal return and enabled us to graph the efficient frontier. We hope that we have provided you with efficient data to help your student investors make the best decision possible.
Thanks again to our analysts. Now we're going to bring up our student investors to hear our final recommendations. Alex and Emily, come on down. So, thanks for coming on the show. Have you guys enjoyed yourselves so far?
Yes, thank you.
Yeah, it's great to be here.
As you've heard, we've come up with an optimal portfolio that meets your needs as investors. We recommend that you make the following investments. 63% of your portfolio should be TD shares. 31% Loblaw, 3% HBC, and 0.7% Eldorado Gold Corp. And the remaining should be our risk-free asset, the T-bill.
Well, thank you so much for all your help.
Oh, it's been a pleasure. And that's all for tonight on Investors of Today. Tune in next week for our special guest, investor extraordinaire Lucas Thung. Thank you very much, ladies and gentlemen.